Folks, today we're going to talk about how you can combine dividend yield with momentum for bigger profits and potentially less risk. Today's a big day for the markets. The Fed is releasing the FOMC data, which will give investors clues on whether the Fed is going to start taking their foot off the gas pedal by lowering the $120 billion per month of bond buying to keep rates low. That's what they've been doing. They've been buying $120 billion worth of bonds to keep rates low artificially. Now, keep in mind, regardless if the Fed takes action today or not, higher rates are coming. It's a fact. And right now, I'm starting to see a shift from large tech stocks that offer higher profit potential at the expense of volatility into safer, calmer, blue chip stocks that have very high dividend yield. When rates go higher, investors tend to favor higher dividend stocks since there's an element of certainty involved that they can't get with high-flying tech. Less speculative, more safety. Moreover, with interest rates moving higher, investors will want to capture some of that income they've been missing for years. And not to mention the tech is trading at an ultra-high, the highest P/E ratio in history, and needs a little cool-off before trending higher. Matter of fact, market internals, such as the put-to-call ratio, are showing strong overbought levels in the tech that needs to cool off. And looking at the chart, the RSI level is overbought as well. Both of these indicators are quite accurate for short-term shifts in price action. And over the next month, I wouldn't be surprised to see large-cap blue chips outperforming the QQQ or the classic FANG stocks. The QQQ is the ticker symbol for the NASDAQ 100, the 100 biggest NASDAQ stocks. But the good news is this. I'm going to show you how you can have your cake and eat it too. Investing in large cap blue chip stocks for income doesn't mean you can't make money on the stocks move too. Matter of fact, some of the blue chips that I'm looking at right now are making new highs or breaking out in a big way. And today I've got two stocks that I have my eyes on in particular. Now keep in mind, I'm not predicting a bear market or a major sell-off. I'm just seeing a strong sector rotation on the horizon, and I want to alert you to it before it happens. And again, these short-term indicators, we're talking 2 weeks, maybe a month. We're not talking about the next year, okay? Short-term. First stock, Iron Mountain, ticker symbol IRM. Iron Mountain Incorporated is the global leader for storage and information management solutions. That's a mouthful right there. Iron Mountain helps diversified customers base reduce costs and mitigate risks associated with protecting and storage of their information assets. Think of Iron Mountain as an insurance policy against lost documents. Similarly to insurance premium, you've got to continue paying monthly to keep the service going. 1 year return, 75% plus. Earnings per share versus previous year, 60% plus. Annual dividend yield, above 5%, which is much better than you're going to get at your local bank right now. Dividend payouts have surged from above 25 cents quarterly in 2014 to nearly 62 cents at present, for a growth of roughly 150% in distributions. That's on top of share appreciation of more than 50% so far in 2021, making Iron Mountain one of the more appealing high dividend stocks right now. We've seen positive earnings surprises last 4 quarters. Technically, the stock is breaking out from an extended consolidation, and I'm expecting strong appreciation or at least price holding steady over the next few months. Expect a price target of about $58 per share over the next quarter, especially if we experience selling pressure in large cap tech. Next stock on my list, you're either going to love it or hate it. Philip Morris, ticker symbol PM. Now, Philip Morris is the leading international tobacco company. In addition to manufacturing sale of cigarettes, including Marlboro, the #1 global cigarette brand, and other tobacco products, what a lot of folks don't realize is that tobacco stocks are some of the best defensive stocks around, since decline in tech causes people to stress out and take up old habits like smoking, drinking. So this stock tends to rise during inflationary periods or during periods of uncertainty in the markets, kind of where we're at right now, or will be real soon. The stock is performing really well lately. 1 year return, 31% plus. 4 quarters of better than expected earnings estimates and surprises. Currently, we're seeing strong momentum out of the stock, and there's a good chance price can reach $110 level over the next 12 weeks. Most importantly, the stock has an annual dividend yield above 5%, which is not too shabby considering the alternative at your local bank, right? The bottom line is dividend stocks will be making a comeback, and these two look like a good balance between collecting extra income and potentially seeing some upside from the stock as well in the near term. I hope that helps. Folks, Joy of the Trade head trader Jeff Zananeri has a proprietary market scanner. Check this out. It allows him to isolate nine trades most likely to go up every single month. Now, each trade benefits from a massive wave of capital that floods the markets like clockwork, giving the in-the-know investors the ability to trade with confidence. Now, this century-old market phenomena is well known by Wall Street and usually stays between former insiders. But Jeff is pulling back the curtain, giving investors the inside edge they need. Good for Jeff. Click on the link below to get access right now. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Folks, I want you to stay ahead of the market by one step, and the only way to do that is by watching these videos. And I'll see you later.